Okay, so let us continue. So our Fibonacci tool works best when the market is trending. The idea is to go long or to buy on a retracement at a fib support level when the market is going up. So when the market is going up, you're expecting a retracement to a fib support level, and then the market should continue going up. And when the market is trending down, you're expecting a retracement to a fib resistance level, and then should continue down. So the idea is to sell when the market retraces back to a fib resistance level when the market is trending down. So before plotting your Fibonacci level, you need to identify the swing highs and swing lows that you are looking forward for a retracement around that swing. So for example, on this chart, I was expecting a retracement from this swing that was produced. So I plotted from this swing low to this swing high, and the retracement occurred at this level. So one thing you should note is that price want to always bounce from this level. So they should be looked at as areas of interest to us. So we'll talk of the equilibrium level, the premium markets, and the discount market. So we start with the equilibrium level. Equilibrium level is simply a halfway point from one swing point to the next. So it's the 50% level. So how do we use the equilibrium level? Usually, when the dealer is forming a peak formation low or a peak formation high, at first you form equal lows and equal highs like this. So we had equal highs, equal lows, and then you find the dealer breaking maybe the highs and then coming back to break the lows. So after breaking the lows, there is where I know that the dealer has now the liquidity needs to reverse the market. So I would wait for a W to form from there. So this is the W that I was waiting for. So I usually plot my Fibonacci tool when the market starts retracing from this level. So I plot my Fibonacci tool from there, and then this second leg W that will come back, this retracement, would come all the way to the second leg. So the second leg to me is around 80 to 88% level. So in between 79% and second leg. So around this area, when the market comes back, then this is my area for second leg. And then the market would form this swing, and we would expect for the retracement that would occur to come back all the way to the equilibrium level, to the halfway point, which is the equilibrium level. So usually the market comes back to retest the order blocks. Like we had an order block here. So we expected for a market to come to retest this order block and then continue up. We had an order block here. That's why you see this pin went all the way to this order block here. And then we had an uptrend. So usually when the market retraces, it comes back to the order block, and then you would find the Fibonacci retracement levels around that area. So here we had another example. So the dealer formed equal lows, equal highs, rated the buy stops, rated the sell stops, and then we had this as a first retracement for this W that we're waiting for. So this retracement came all the way to the second leg. And if you look at it, we had another block right here. And then from there, the market went up, and then we had this retracement to the halfway point, and then the market went up. So sometimes it may happen like what we have here, like the market formed equal highs, it went to grab liquidity, and then also this it went to break it. So we had like several stop rates here, and then the market did fall level up. So we didn't have a retracement coming back to the second leg, but our first retracement here came all the way to the halfway point, the equilibrium level, and then we had this. So depending on where the order blocks are, you would find the market retracing to certain Fibonacci retracement level. So like what we had here, the order block was right here. And if you look at it, it was around the sweet spot automated energy. So the market did not come all the way to the second leg, but it came all the way to retrace this order block. And the sweet spot optimal trade entry was right there. And then we had this uptrend, but then we had this retracement coming back to the equilibrium level for a continuation going up. So let's talk of the discount markets. So the discount market, if we talk of the discount market, we are talking of a bull market. So here we had a peak, the market moved up, we had this retracement, came all the way to the 79% level around second leg here. And then the market moved up. So we had this retracement coming back to this order block. And if you look at it, the equilibrium level was broken. So from the equilibrium level to the 62% level, this is the discount market. So sometimes we should allow for the market to break the equilibrium level and reverse around the discount market. So here we also had a break on the market reversed on the discount market. Now for the premium market, when the market is trending down is where we find our premium markets, like here, where the market did break the equilibrium level, reversed on the premium market, and then we had this downtrend. We also have the optimal trade entry here, 70.5% level, and it usually occurs when there is a mitigation block. Most of the times mitigation blocks appears from there. Here we had the mitigation block. So this retracement came all the way to the sweet spot, optimal trade entry, and then we had this downtrend. So usually for a bigger retracement like this, which breaks the equilibrium, the premium market or the discount market, going all the way to the sweet spot occurs when the market had a larger swing like this. So this is the half-hour time frame. And if you look at this, we had like 3 levels going down. So this was a whole week move. So we should be expecting for a bigger retracement, and this retracement usually finds the sweet spot optimal trade entry, and maybe a certain order block around here. So it's a retest on a certain order block. And here we had this as a retest to this order block here. And the market did retrace to the sweet spot optimal trade entry. We had an uptrend. And if you look at this, it formed a mitigation block around this area. But our mitigation block was here. And this retracement did not come to find it. It simply came to this area of support and then went up. So those are a few teachings on how to use the Fibonacci tool. So the pivot points now. The pivots are calculated based on daily candle. Yesterday's price action gives you today's pivot points. So on our chart, you'll find the pivots right here. So we have the M3 pivot, S1, we have the CPP, which is also called the pivot itself. We have the M3, the R1, M4, R2. So we also have the S2 down here. So these are the pivot points. So we have the red zone and the green zone. So the red zone is the overbought area. The green zone is the oversold area. So we look for sells when the market is on the red zone. We look for buys when the market is on the green zone. So depending on where the market will be going, like if the market is an uptrend, it's a downtrend, you would find the market having a Asian range, which is a consolidation. And then we would be expecting for a stop and high. Now, the stop and high has to find this red zone, and the pivot point that we'll be looking forward for a pattern to be formed is the M3 pivot. So you'll find that the market is forming a pattern around M3, and then you would see a downtrend from there, and our target should be M1. So M3, M1 day, and then the market will end the day back to consolidation. And if it's an uptrend, you would have an Asian range, which is a consolidation. We would have a stop and flow, and the pivot that we'll be expecting for the market to form a pattern would be the M2 pivot. So around M2 is where we should be expecting for a W pattern for us to buy. And then from there, you see 3 intraday levels, and then the day would end back to consolidation. So red candle indicates M1, M3 day, green candle indicates M2, M4 day. But I've marked these areas, the 3 pivot levels, as buy zone if you're looking for an uptrend. So sometimes the dealer will form a pattern around the CPP, sometimes M2, sometimes the S1. And for sell zone, I've marked the CPP, the M3 and R1. So around these 3 levels, if you find the pattern forming from there, then it's a high probability setup for you to take for a sell. So I've marked the 3 pivot as our sell zone area. So that's all on the indicators. And now I should be going to talk of the peaks. How do we identify that the dealer is forming a peak? So you first look on the previous cycle. Is the previous cycle complete? As there are 3 levels of drop or rise, is 3 times ADR met. So if you see that the previous cycle is complete, and then you find the exponential moving average on the hour and 15 timeframes are found out as a level 3 behavior, and as the market consolidates, they come close to each other, then that would indicate that the dealer is now forming a peak. So the TDI shark fin on the R4 and the harmonic pattern add to the confluence that the dealer is now forming a peak. So these are the confluences that I usually look for when I'm not analyzing the market when the dealer is forming a peak. So we have 3 types of peaks, and I've categorized them in terms of how the dealer grabs liquidity. And we have the consolidation peak, we have the EMA peak, we also have the news peak. So for a consolidation peak, the dealer grabs liquidity through a 2+ days consolidation. So you should expect for the dealer to chop around, and then a good M or a good W formation will be formed. Sometimes the dealer, or most of the times, the dealer would raid buy stops or sell stops before forming these M's, before forming these W's. And sometimes you find the head and shoulder pattern. So this is a 3 days consolidation. So this is the day that the dealer has applied the brakes. I call this the first day. On the next day, I should expect for the dealer to consolidate. And on the 3rd day now is where I should expect for the dealer to move. So 1, 2, 3, So the dealer moves. So when I see this, I know that this is now a very good consolidation peak. And if you look at it, the dealer has grabbed liquidity as the market was consolidation. So sometimes we would have a head and shoulder like this. So the first shoulder is usually a level 2 from the previous cycle, level 2 consolidation, and a level 1 consolidation would of the newly formed cycle would be our next shoulder, and this is now the head. So a very good consolidation from Tuesday here. It came to move on Friday. So we had a very long time of consolidation. So this is a consolidation type of peak. And here we also had a consolidation type of peak where the dealer applied the brakes here. So sometimes when you see a pin like this, you wouldn't find the dealer coming back below it. So I call this as a trap liquidity around there. And then the dealer consolidated on Friday. On Monday, he did not move. And then on Tuesday, he came all the way back to the blue tracer and then went up. So when I draw this this box, this rectangle here, it's like a trap zone where I usually expect for the dealer to pin around this, so not breaking this, and then eventually the market will move up. So I would expect for the third day, if at all the market would be moving for the third day, to come down here and then go up, but it did not come down here, so I wouldn't be taking a trade here. And on the next day is where I came down to the blue tracer for this uptrend. So here we had this spin, and then the market moved on the second day. So the market moved on this second day, but then it came all the way to bounce on this area and then came back to the trap zone. And then we had this downtrend from there. We also have the EMA peak. How does it occur? When the cycle is complete and you find prices around 800 EMA on the hour time frame, and then the dealer forms a consolidation type of peak or a news peak around that, then we call it an EMA peak. So simply a good M, a good W formation around the blueberry on the hour time frame. After the dealer completes the cycle, that's an EMA peak. So the trade we took yesterday on NZDJPY was an EMA peak. It was a very, very nice peak formation high around the 800 EMA. So here we had Euro JPY forming a peak formation low around the 800 EMA. So a very good consolidation peak here, a 3 days consolidation. And a move started on the 4th day, going up. No, the move started on the 3rd day. This was also a very good.
You expect the move first, no? After the peak.
I'm expecting the move. Pardon, please.
First you have the move, right? You have the peak. For example, can I draw?
Yes, you can draw.
You expect the consolidation? No, not here. You expect the consolidation and then this move. No.
Yes, after this consolidation, there's a way that we usually take a trade around this consolidation, and to come to talk of it in a bit.
Okay.
So just be patient with me.
Okay.
So here we had also a peak around the 800 EMA as a consolidation peak. So this was also an EMA peak. So these peaks usually occurs from time to time. So I teach them so that if a student sees them, we can easily identify it, because they usually producing a very good move. Okay. Yesterday, I think we had also one on Euro JPY. Yes, we had on Euro JPY and also on the NZD JPY. We also have the news peak, and then the news peak, we'll be talking about the first leg news peak and the second leg news peak. Now, let's start with the first leg news peak. Here we had this as a peak reset. We had level 1, the market chopped around. We had level 2, the market chopped around. If you look at it, the market formed equal lows, producing this move going up. It formed this equal lows, producing this move going up. And here the market came and retested this 50 MA, having this move going up. So this was all the dealers move to induce traders to take the wrong position of the trade. And then the news came in and he used the news to complete level 3. So down here, there was a liquidity pool area. So when the dealer uses the news to complete level 3, he usually also grabs liquidity at that moment. So we would not be expecting for the market to consolidate for a very long time in order for it to reverse. So we shouldn't be expecting for the market to reverse immediately, like what happened here. So immediately after this move, we should expect the market to reverse. So it would appear like a V, or if it's a downtrend like this, it would appear like an A. So the dealer used the news to complete the cycle. So right above this equal highs is where there's the liquidity pool area. After grabbing the liquidity needs, then the dealer would reverse the market. So that's the first leg news peak. And for second leg news peak, usually you would find the market consolidating around level 3. So here we had a consolidation around level 3. And there's a high impact news coming affecting, this was NZD news. So the dealer used the news to shift the trading zone. Like the dealer was trading going down. So we had this downtrend, and then right after the news release, he used the news to shift the trading zone away from the sellers. So that's a second leg news peak where the dealer will use the news to start the cycle. Usually this type of news moves a lot of pips. So if you find the market is around level 3 and there's a high impact news coming, then you should be expecting for the market to move at least 1.5 ADR to 2 times ADR. So here we had this as a news. So the dealer used the news to shift the trading zone. So this was the time when there was Brexit. So here we had also Brexit move to form this V. So those are the 3 types of peaks that we should be expecting from the market. And those are the ones that I personally am looking forward to trade them. And as a MQP student, you should be looking forward for these peaks. So let's talk of trades now. We have peak trades and we have the AFP trades. They're away from the peak trades. Now let's start with the peak trades. And when we talk of the peak trades here, we'll be talking of the consolidation type of peaks. So here is where the dealer applied the brakes. I should be expecting for the market to consolidate on the next day. And then on the third day, when the dealer comes to the blue tracer, forms a pattern there, gives me an entry confirmation, is where I have my entries. So here we had a W around the blue tracer, 5 and 13 crossover, candle closed above 50 EMA. So that was our entry confirmation. And if you look at it, the market did consolidate a bit, and then we had this move going up. And if you look at this Asian range is around 15 pips. So this move down here, it will be around 7 or 8 pips. And then we had this consolidation going up. So I usually put the stop loss around 25 or 30 pips. So on the third day is where I'll be looking forward for the market to come to the blue tracer, gives me a pattern there. There is where I take my trade. So yesterday I took a trade on NZDJPY and it was on the third day. Although it didn't go all the way to the blue tracer, but he had the conferences for the sales. So it's around the M3 and we had a very good stop point. So it was a good go. This is where the dealer applied the brakes. He moved to the 200 EMA. So when you find the dealer is on the peak, he bounces around the 200 EMA, you should expect for the market to come all the way back to the peak. So on the second day, on Wednesday here, he did break this high. So he did break this high and then he came back down. So this was a very nice pattern. So I entered this pattern early. So I entered this trade early. And then the market also bounced back on this mile, and then we had this move going back to the blue tracer. And then there's where we had our blue tracer pattern. So on the third day is where he formed the pattern and he moved. So if you look at this trade, it's as if I took them on the third day. But actually I took them on this second day. So here we have another peak trade. The dealer applied the brakes this day. We had a consolidation on the next, on the Friday, came to the blue tracer, formed a pattern for us to buy. And I remember I took this trade on CatChef. So that's how you grab the peaks. I hope I've answered your question. And we also have the ID50 trade as a peak trade. Sometimes the market moves early, like here. This is where I apply the brakes. On Friday, consolidated. On Monday, he moved early during Asian range. And usually don't take a trade during Asian range. So when it moves early like this, we have 13 and 50 crossover right there. And the market moves away from it. After 13 and 50 crossover, we have our first pullback towards the 50 MA. And around the 50 MA, they form a reversal pattern there. The market forms a reversal pattern. There is that is what we call an ID50 trade. So this was an ID50 trade right there. So you wait for the reversal pattern. There is where you enter your trade. So it's also a peak trade, but usually take it after 13 and 50 crossover. The market moves away from it, and then first pullback towards the 50 MA. Our reversal pattern and our entry confirmation would give us our entry. Now, those are the peak trades. Now, let's talk of the away from the peak trades, AFP trades. Now, we usually trade away from the peak. When the peak is high, we look for sells. When the peak is low, we look for buys. So if the dealer forms a peak formation low, we always look for buys. If the dealer forms a peak formation high, we always look for sells until the cycle is complete. Now we'll be talking of the safety trade and the EMA trades basically here. Now let's talk of the safety trade. A safety trade occurs when the dealer has done a visible stop point and provides a pattern for us to trade away from the peak. It's called a safety trade because we usually trade it once the dealer has done the stop point. So it's very safe for us because the dealer has given us what we are looking for. Usually, safety trade occurs after level 1 is completed. So you would find 50 and 200 crossover, and 1 times ADR has been completed. So 50 and 200 crossover on the 15 minutes, 1 times ADR has been completed. And then you find the dealer having a very visible stop point. So we had 3 swipes going to the low, 1, 2, 3. The pattern forming around 200 EMA. It's not necessary to be as exact as this. Sometimes the pattern will be here. So around 200 EMA, after 50 and 200 crossover, this is our safety trade. So you enter your trade there. So on the hour one, it's like an ID50 on the hour. because 13 and 50 crossover on the hour indicates level 1 lock. And this pullback will come all the way to the 50 EMA, which is the same as the 200 EMA on the 15 minutes. So we also have a safety trade here. So after the safety trade, any other pullback towards the 200 EMA, we call them 200 bounce trade. So after the safety trade, if you find any other pullback towards the 200 EMA, giving you a pattern to trade away from the peak, then that's the 200 bounce trade. We also have the 50-50 bounce trade, which occurs after the ID50. So after the ID50, you might find price bouncing around the 50 EMA once or more than once. Sometimes it may offer a pattern, an M, a W. Then that's the 50-50 bounce trade, and it's usually type 3 London pattern. And we have the blueberry trade also. So we have an example here of a pin on the 50 EMA type 3 London pattern. That's a 50-50 bounce trade right there. We have a pattern, a morning star pattern around the 50 EMA. And usually it occurs very early. Yeah? We also have a 50-50 bounce trade right here. Now this is the blueberry trade. The dealer breaks the blueberry, comes back up, gives you a pattern to trade away from the peak. That's a blueberry trade right there. So you should wait for the dealer to break the blueberry, coming back up, gives you a pattern for you to trade away from the peak. That's a blueberry trade right there. Yesterday we had a trade on GBP/JPY, and it was a blueberry trade where the dealer did break the blueberry, come back for a retest on the blueberry, and gave us a pattern to trade away from the peak. So like this, break at the retest of the blueberry, that's a blueberry trade. So yesterday we had that on GBP/JPY. I remember I sent the setup on the premium group. I've added to the premium group already.
Sorry, no, you don't have add me.
This one. Okay, I've just added you. Okay, EMA combo trades. EMA trades are usually effective when you find these 4 EMAs, the one with the period of 5, 13, 50, and 200 EMA are close to each other, and price is forming a pattern. Okay, so EMA combo trades. EMA trades are effective when you find these 4 EMAs, the one with a period of 5, 13, 50, and 200, are close to each other on the 15 minutes time frame, and price is forming a pattern for you to trade away from the peak. So here we had the 4 EMAs were close to each other. The dealer gave us a W here, but because of this big move, you cannot see a W, but usually the dealer gives you a pattern for you to trade away from the peak. So this is what we call EMA combo trade. Price usually runs effectively, like what you see here. You see a very great move after the EMA combo, because around the CMAs you find retail orders, so you expect for the dealer to have enough liquidity. And after that, the only retracements that we should be expecting a small retracement until the cycle is complete, usually 50-50 bounce trades like this. So if you find an EMA combo today, you should be expecting for a 50-50 bounce trade tomorrow. And here we also had a break and a retest on the blue tracer going up. So we had EMA combo trade here. After that, we only had 50-50 bounce trades until the cycle was complete. So basically, these are ideal market maker trades. This is the peak trade. This is the ID50 there. We had a 50-50. This was like a safety trade. So the stop hunt started from this area here, going up. But it was also a 50-50 bounce trade, and we had a blueberry trade right there. And if you look at this bigger move, it's because we also had EMAs close to each other here. So these are the trades that I usually take, trades that I'll be looking forward to trade in the market. They happen every day. So if you master them, then your consistency will improve. You'll be taking trades as I do.
Mm-hmm.
Okay, so that's all I have for today.
Okay.
If you have any question.
No, that was a nice class. Thank you.
Okay, so thank you for listening. I'll send you the recording as soon as they're converted.
Mm-hmm.
And have a nice day. We'll meet again tomorrow.
Okay, thank you.